Hi, I'm Nilus Mattive for Money and Markets TV. Last week I made the case that dividend stocks are a better investment than treasuries right now. A couple people wrote back with their own views, and I want to highlight one of them in particular. A viewer named John says, if you have a couple $1,000,000, higher priced dividend stocks make sense. For the smaller investor, not. $100,000 is not going to give you any meaningful dividend income. I've heard this argument before, that dividend stocks are only for the rich. So I'd like to address it today. Yes, it's true that a $100,000 portfolio, like the one I'm managing for my father, will not be able to produce enough income for anyone to live on comfortably. Even if you bought the most aggressive high-yield stocks out there with the entire 100 grand, which is not my recommendation, you would still only be generating about $10,000 to $15,000 a year. But here's the thing. I'm not saying a $100,000 portfolio of dividend stocks should be your sole source of income in retirement. Hopefully, you will have other streams of cash coming in from Social Security, a pension, and other sources. But even if you don't, I still believe that a $100,000 portfolio is best invested primarily in dividend stocks, which give you the ideal combination of growth, safety, and income. Think about it. The value of your nest egg is the sum total of whatever you've saved and earned up until this point. So whether it's small or large, it's all you've got. Your only real decision is how best to invest it going forward. Perhaps you're thinking that you'd be better off putting the whole amount into some penny stock and quadrupling your fortune overnight. Well, I'm not going to say it can't happen. I'm just saying it's very unlikely to happen. And in many cases, you'll end up with less than you started with. On the other hand of the spectrum, you could just keep all your money in cash or short-term treasuries. With this approach, you'd have very little risk of loss, other than in your money's purchasing power over time. Yet you'd also have practically zero chance of ending up with more than you started with. Meanwhile, withdrawals from your nest egg would quickly take your balance down to zero. If anything, I would argue that someone with many millions is precisely the person who can afford to avoid risk altogether and opt for cash or short-term treasuries. This is exactly what they mean when they say you only need to get rich once. Ironically, if you had many millions, you'd also be able to take a flyer on a penny stock if you felt like it. Hey, what can I say? It's just nice to be rich. But for everyone else who doesn't have a massive portfolio, the best strategy is to split the difference in terms of risk and reward, and to opt for a conservative mix of stocks that can rise in value over time and still kick off reasonable income year in and year out. But there's another assumption built into John's argument that dividend stocks are only for the rich. And that assumption is that we're talking about right now. Just to be clear, I do think that dividend stocks are still a good answer for most investors right now. But if you've got another 10 years or longer before you really need to start tapping that $100,000, then there's a strong chance that just your portfolio of dividend stocks could be enough to sustain you. That's because when you buy stocks that steadily raise their payments, your effective yields go way up over time. Just this fact means you could easily be earning $15,000 to $20,000 a year from your original $100,000 portfolio a decade from now. In addition, you could use those 10 years to reinvest your dividends into more shares of stock. That puts an extremely powerful form of compounding to work for you. Because your dividend streams are growing over time, your number of dividend-paying shares are growing over time, and those two forces continually feed off of each other. So now we're talking about $30,000 a year from your original investment. Plus, we haven't even considered capital appreciation. No, the broad US stock indexes haven't risen over the last decade. But certain companies, including a couple of my favorite dividend stocks, are worth more today than they were in 2000. Additionally, it's a good bet that the next 10 years will be better than the last 10. So put it all together, and today's 55-year-old with $100,000 to invest could be 65 and sitting on a $150,000 nest egg, producing $30,000 or more in income. Again, there's far more historical reason to believe this scenario than the idea that you will pick the next Apple, or that sitting in cash will do anything for your portfolio's ability to grow. And that's why, whether you're rich or of modest means, dividend shares should play a part in your retirement strategy. I'm Nilus Mattive for Money Markets TV. Thanks for watching.